Have you heard about the massive acquisition that's about to reshape the landscape of multifamily real estate across North America? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In today's news, a significant development in the realm of multifamily real estate is making waves. Morgan Properties, a major player in the apartment sector based outside Philadelphia, has agreed to purchase Toronto-based Dream Residential Real Estate Investment Trust. This acquisition is valued at approximately $354 million United States dollars and is set to expand Morgan Properties holdings into the U.S., Midwest, and the rapidly growing Sun Belt regions, according to CoStar News. Dream Residential REIT, headquartered at 30 Adelaide East in downtown Toronto, boasts a portfolio of 15 properties and around 3,300 units, primarily consisting of garden-style apartment complexes. These properties are strategically located in metropolitan areas such as Dallas-Fort Worth, Oklahoma City, and Cincinnati, areas known for their robust rental markets. This deal, if approved by stakeholders, would see unit holders receiving $10.80 per unit, representing an 18% premium over the REIT's recent closing price. It's a strategic move that allows Morgan Properties to diversify its already vast portfolio, which includes over 100,000 units across more than 360 municipalities in 22 states. The acquisition marks a significant step for Morgan Properties, which is already ranked as the third largest apartment owner in the United States by the National Multifamily Housing Council's 2025 Top Owners list. The company, founded in 1985 by Mitchell Morgan, is now led by co-presidents Jonathan and Jason Morgan. They have their sights set on growth in high-demand regions, where rent growth has outpaced the national average. For Dream Residential, this transaction signifies the culmination of its strategic review and the end of its service agreements with Dream Unlimited and Paul's Corp. This transition includes a $7 million United States dollar separation payment to address outstanding fees and wind-down costs, as noted by CoStar News. As we look towards the future, the CBRE Canada Real Estate Market Outlook for 2025 paints a picture of both challenges and opportunities. The report highlights that Canada is at an inflection point politically, economically, and socially, particularly around issues like housing affordability and congestion. Despite these challenges, Canada continues to be a growth play, ranking among the top G7 nations in GDP, population, and employment growth over the next 5 years. This is a promising sign for commercial real estate demand. The report suggests that 2025 will be a year of increased activity as the cost of capital crisis begins to ease. Investment and leasing activity are expected to rise, contingent on global bond market conditions. This is good news for those of us in the multifamily sector, as leasing fundamentals are improving overall, though the influx of new supply in office, industrial, and residential sectors will take time to work through. In terms of the economy, despite modestly lower growth forecasts due to immigration curbs, Canada's longer-term outlook remains robust compared to other G7 countries. This bodes well for commercial real estate demand. The capital markets are seeing improved sentiment with stronger investment activity anticipated in 2025. Cap rates for some asset classes might start compressing modestly, depending on global bond market conditions. For the debt markets, availability is expected to improve, though lenders will remain selective. Credit spread dynamics should begin to normalize, and loan underwriting will align with broader market trends regarding rents and vacancy rates. This is crucial for investors looking to expand their portfolios in the coming years. The office sector is on the verge of recovery as occupiers shift back to a growth mindset. This shift, combined with a slowdown in new supply, could lead to an undersupply of modern, amenitized, and environmentally sustainable buildings. It's a trend to watch, especially in cities like Hamilton and Kitchener-Waterloo, where demand for high-quality office space is growing. Positive leasing intentions in the retail sector, coupled with a supply-constrained landscape, will push retailers to expand into secondary markets and adapt their store formats. This could be a golden opportunity for investors in regions like Niagara and Burlington. The industrial sector is facing some headwinds due to softer demand and an influx of new supply. but the market is working towards normalization, which might happen sooner than expected. This sector is vital for economic growth in Ontario, and any stabilization will be beneficial for investors. Lastly, the multifamily sector, despite uncertainties from immigration curbs and new supply, holds solid long-term growth fundamentals. This presents a compelling investment thesis, especially in burgeoning areas like Oakville and Cambridge, where population growth is driving rental demand. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.